Thanks for joining us. You're watching First Business this Thursday, 13th of February. A busy day ahead, as we mentioned there. Certainly a SPI future suggesting we could see continuation of gains at the open after that 1% or more lift on the ASX 200 yesterday. Wall Street certainly pretty steady after its big recent run-up over the past 4 sessions. Well, to some of the corporate news we're going to be watching today, Telstra set to report its first half numbers, with analysts expecting a 13% rise to around $1.6 billion. Some have it up to $1.8 billion, but the key focus for investors will be whether the group will lift its dividend for the first time in years. Mobile revenue is expected to drive the result. It's set to rise almost 6%, while mobile margins also set to improve by 1% on last year. Macquarie also watching for market share gains in mobile, and certainly we'll be bringing you those results later today as soon as we get them. Rio Tinto will release its full-year earnings results later today in London, with analysts tipping the miner will lift its dividend. JP Morgan and Deutsche Bank expecting Rio to pay a dividend of $1.81 a share. That's up from $1.67. However, Credit Suisse is more optimistic, predicting $1.92 a share. JP Morgan expects Rio to post full-year underlying earnings of $9.8 billion US, up 6% on year. The broker also says an announcement of a share buyback or extra dividend is unlikely, but believes further divestments from Rio in 2014 could see this happen next year. And of course, we are going to be speaking with Rio Tinto's CEO Sam Walsh, and we will bring you that interview later today.
Obviously, commodity prices have passed their peak, so the key for these guys is being able to control their costs. We think that Rio's $2 billion cost out was achieved quite possibly well in advance of the end of their financial year, so there may be some positive surprise there. There's very well publicised cuts in capital expenditure, so it should be a pretty good time for Rio. The question is how much pressure is on the board for them to have some form of capital management. We think it might be a little bit early for them to be announcing that tomorrow, but if they don't actually come out and announce it, certainly the market will be looking for some indication that it is on their radar, and you'd imagine it would be.
To economic data, and the number of people with jobs is tipped to have risen by 15,000 in the official labour force data due out a little later today. But that won't be enough to prevent the unemployment rate continuing its rise, with the forecast for an increase to 5.9% from 5.8% in December. The consensus of economists expect the participation rate will remain steady at 64.6%. In December, the number of employed fell by 22,000, which was much larger than expected, and was mostly down to a big fall in full-time jobs. Well, let's get some more on all of this. Our guest host joining us on First Business today, HSBC Australia Chief Economist Paul Bloxham. Paul, always great to have you on the program. Just firstly, on the jobs picture, what's your expectations for what we'll see today?
Well, the first thing we always know about the labour force survey is that it will deliver surprises, because we know this survey is extremely volatile. As you say, last month it fell 22,000. We saw 22,000 jobs lost in December. So we have in mind that actually we might see a fair bit of that retraced. Because we had such a weak December print, it may turn out the January numbers are a fair bit stronger. So we're a bit above consensus at the moment. We think there'll be 30,000 jobs created in January. We think that will see the unemployment rate remain broadly stable. And this fits our broad story, which is that we think the economy was really starting to turn around in the fourth quarter of last year. We've seen that across a range of indicators. The housing market's up, building construction approvals are up, business conditions improved, retail sales improved. Now, we don't think that's going to feed through to a sustained improvement in the unemployment, a really strong improvement in the unemployment quite yet, but we do think that the labour market will start to show signs of sustained improvement as we look into coming months. So whether it arrives this month or not is a key question, because of course it is a very volatile survey. We think that we might see some signs of a pickup this month in employment and some stabilisation of the labour market, but as a broad theme, we've got in mind that the labour market will start to improve more significantly in coming months, probably around March, April, May, because the labour market tends to lag the rest of the cycle, which has already turned.
I just wanted to turn to China as well, because we had that trade data yesterday. It's really buoyed markets. The Aussie dollar's back above 90 US cents. What was your view on that? I mean, obviously that sort of China bear theme has been something that has concerned markets recently and last year. What do you think now after that trade data?
Well, I think the starting point is we know the advanced economy is showing a bit of improvement, and indeed that's what most forecasters, including ourselves, have got in mind. The US economy is on a modest road to recovery, and Europe is stabilising. European growth they'll probably see regrowth this year rather than contract like they did last year. And that we have expected for a while would provide a bit of support for trade in Asia and in particular in China. So the question, of course, the hard trick is knowing exactly which month it shows up in. Those January numbers look as though they're showing signs that we're seeing trade rise on the back of an improvement in the Western economies in particular. So the Chinese numbers were fairly strong. Of course, one of the key questions or one of the key challenges is that the January and the February numbers are thrown around by Chinese New Year effects, so it's not quite clear whether this will be a sustained improvement, but it's certainly in the direction we had in mind, which is we thought the trade data for China would start to improve as the Western world starts to improve as well through this year. So it's all round quite a positive story, and as you say, one of the things that drove is a rise in the Aussie dollar.
Absolutely. Well, let's just check out how bond markets have been reacting to that, and of course Janet Yellen's commentary as well yesterday. Let's get some views now. Jonathan Sheridan joining us from FIIG Securities. Jonathan, good morning to you. Yeah, just take us through what you've been seeing overnight in the bond market.
Good morning, Bridie. Well, it's a pretty quiet night in the bond markets, as it was in the US equity markets. They seem to be taking a breath after the last 4 days of gains. Yields on the US 10-year and the Aussie 10-year up about 4 points.
Well, so what do you expect from the Aussie bond market today then?
I think it's going to be another fairly quiet day on the Aussie bond markets today. Investors still just digesting really Janet Yellen's first public testimony, which I guess is much of the same.
Yeah, and I mean, on that, I mean, do you put a lot of this optimism down to what Yellen had to say in that testimony yesterday? I mean, because it wasn't anything new. I knew she was sort of optimistic about the economic recovery and then also sort of continuing to gradually taper. Why do you think the market reacted as it did?
Well, I think that markets like consistency. They were reassured by the fact that she's not changing from Ben Bernanke's stance. There's been a bit of uncertainty, I guess, as there is with any change, but to have her reconfirm the stance of the Fed that stimulus will remain as it's appropriate, and therefore also the taper will remain, but as long as the data supports it, then that's why they reacted so positively.
Just on the agenda today, of course, we've got the labour force data due out for January there, another rise in unemployment expected, as we've just been discussing with Paul. We saw that consumer confidence tumble yesterday, the Aussie dollar's above 90 US cents again. How are you viewing all of this, and do you think this changes at all the RBA, its outlook?
Oh, look, I think it's a bit of a difficult balancing act for the RBA, to be honest. An improving economy is obviously what they're after. They've had record low interest rates to stimulate that for the last period of time. It's a difficult thing. With the Aussie climbing, you know, Glenn Stevens has publicly said he'd like a lower Aussie dollar. The thing with a lower Aussie dollar is, of course, it brings inflation as we import goods that now cost us more. So it's difficult for the RBA, but I think overall improving economy is positive.
Jonathan, thanks so much for joining us this morning.
Thank you very much.
Jonathan Sheridan there from FIIG Securities. Well, let's return to our guest host, Paul Bloxham from HSBC Australia. Paul, I'm looking forward to getting your view on this too, because you were talking there about the expectations for the labour force data, what we've been seeing in terms of consumer confidence. Are you worried at all by that tumble this month there? I mean, we've had a lot of bad news, you know, Qantas, Toyota, just to name a few. What's your sense of you know, that part of the economy and what the RBA needs to do?
Well, there are two options here. I mean, one option is you read the consumer sentiment survey and you say consumer sentiment is declining. It's back to its break-even level of just over 100. It might mean that consumption is slowing down a bit in the first couple of months of this year, after having actually picked up reasonably solidly, at least on the retail numbers, in the fourth quarter of last year. So that's one option. The other option is to say there's been a lot of bad news and a lot of front-page news focused on Holden and then Toyota and Qantas, as you mentioned, and that's having an impact on how happy consumers are about the world and on how uncertain they are about the economy, but it may not actually be affecting their underlying spending decisions. And you could jump either one way or the other, so this is a very hard thing to necessarily read, but my sense is that really what we're seeing is we're seeing an improvement in some of the fundamentals in the economy. We know that house prices are rising and they're continuing to rise. We're seeing indicators that the housing construction cycle is turning. improving. We're seeing more indications, and we saw in the fourth quarter indications that the retail environment was improving, and it all makes a lot of sense given we've got low interest rates and a housing market that's rising quickly. So in my view, I think for the moment we think that consumer sentiment number might just reflect the bad news effect rather than a genuine turn in consumer sentiment, a genuine change in consumers' willingness to spend. So for the moment, we think it's still above its break-even level. It's not falling dramatically. We still think that the economy is gradually improving. We think the fourth quarter actually saw a fair bit of improvement in the economy, and we think the RBA is going to read it that way too.
All right, Paul, lots more to ask you about. Great to have you here. Paul Bloxham from HSBC Australia here with us on First Business this morning. Coming up, we're also going to be crossing live to the CME Group in Chicago, chatting to Scott Sheridan from Treen. There he is. He's going to be giving us his thoughts on the markets in just a moment.